There's a metal sitting in vaults right now that most people walked past 1,000 times this week without ever thinking about it. It's in your phone, it's in your car, it's in the solar panels going up on rooftops all across America. And while regular people aren't paying attention, some of the most quietly aggressive institutional accumulation in over a decade is happening around it right now, before most of the public even knows a story exists. We're talking about silver, and I know what you're thinking. Silver? Isn't that the thing your grandmother kept in a cabinet? The second-rate gold? The metal? That never quite breaks out? I get it. That's exactly what most people think. And that assumption, that comfortable, dismissive assumption, is precisely the reason this opportunity has stayed hidden in plain sight for so long. Because here's what most people still don't realize. Silver isn't just a precious metal. It isn't just an inflation hedge. It is quietly becoming one of the most strategically critical industrial commodities on the planet. And the window to understand that before prices reflect it. Maybe closing faster than anyone in mainstream finance is willing to admit. So if you're new here, welcome to the Bullion Horizon. Hit that like button right now. It genuinely helps this channel reach people who need to hear this kind of analysis. And if you haven't subscribed yet, do it before this video ends, because what we're about to walk through is the kind of thing that only makes sense if you stick around to see the full picture unfold. Let's go back to 2010 for a second. Silver was sitting quietly around $14 an ounce. Most people weren't paying attention. The aftermath of the financial crisis had everyone's eyes locked on bank bailouts, unemployment lines, and whether or not their home was worth what they paid for it. And while the public was distracted, a quiet but relentless accumulation was underway. Sophisticated investors, hedge funds, family offices, commodity traders who read balance sheets the way most people read headlines were loading up. By April of 2011, silver had exploded past $49 an ounce. In roughly 18 months, it had more than tripled from where it quietly sat while no one was watching. That is not ancient history, that is a pattern. And patterns in financial markets tend to rhyme. Now we're approaching 2027, and the setup today is in many ways more structurally compelling than anything we saw in 2010. But the surface level narrative around silver, what most casual observers see, doesn't capture the full story, not even close. And this is where the story changes completely. Because the old case for silver was simple. When the dollar weakens, when inflation rises, when governments print money, hard assets hold value. That's true. It was true in ancient Rome when emperors debased their coins. It was true in Weimar Germany. It was true in every currency crisis that followed. Silver, alongside gold, has served as money and stored value for over 5,000 years of recorded human civilization. That's not sentiment. That's a track record that outlasted every fiat currency ever created. But here's where it gets genuinely interesting. The new case for silver isn't just about inflation or currency debasement anymore. Something structural shifted. Something that has nothing to do with central banks printing money and everything to do with the physical world we're building around us. Solar panels, electric vehicles, semiconductors, advanced military electronics, medical devices. These aren't fringe technologies anymore. These are the backbone of the global economy being rebuilt in real time, and every single one of them requires silver, not as decoration, not as a store of value, as a functioning component that cannot be easily replaced. Silver is the most electrically conductive metal on Earth. It's not a close race. It conducts electricity better than copper, better than gold, better than anything else we've found in nature. And for applications where efficiency matters, like solar cells, where every fraction of a percent of conversion matters, there's no substitute that performs the same way at the same price point. You can't just swap it out. Now pay attention to this part, because this is where supply and demand starts telling a genuinely alarming story. Global demand for silver in industrial applications has been climbing steadily for years. Solar panel manufacturing alone has become one of the single largest consumers of silver on the planet. And the projections, based on current government commitments to green energy transitions across the United States, Europe, India, and China, suggest that solar demand for silver will continue to accelerate well into the next decade. Meanwhile, the supply side of this equation has its own set of problems that almost nobody is talking about in mainstream media. Silver is not primarily mined by itself. About 70 to 80% of silver produced globally comes as a byproduct of mining for other metals: copper, zinc, lead, gold. That means silver supply is largely dependent on decisions being made for entirely different markets. If copper demand softens, mines scale back. If zinc prices fall, operations slow. Silver comes along for the ride whether the market needs it or not. And right now, exploration investment in new silver deposits has been underwhelming for years. The lag between discovering a new deposit and actually producing from it can be a decade or longer. The structural tightness in supply isn't a prediction, it's already built into the geology. But here's what most people still don't realize. The above-ground stockpiles of silver that the world relied on for decades as a buffer, those strategic reserves that smoothed out supply shocks, have been drawn down dramatically since the 1970s and 1980s. The United States government, which once held billions of ounces of silver, liquidated most of it. The strategic buffer is essentially gone. What's left is what comes out of the ground each year, plus recycled silver from electronics and photography. And demand, right now, is running ahead of that combination. This is the part the mainstream media rarely explains properly. When demand structurally exceeds supply year after year, the price doesn't just drift upward politely. It can gap. It can move in ways that feel sudden and confusing to people who weren't watching, the foundation being laid underneath. And the people who are watching, the people who understand what a structural supply deficit actually means for pricing over time, are not making noise about it. They're making purchases. Let me paint you a picture of what this actually looks like from the inside. Think about the contrast between two types of investors. On one side, you have the average retail participant. They see silver at $30. They remember when it was 19. They remember when it ran to almost 30 and then gave it all back. They're cautious. They're waiting for a pullback. They're watching the price move and wondering if now is the right time. Their emotion is uncertainty, maybe a little fear of buying too high. On the other side, you have what some people call smart money. Institutions, funds, sophisticated individual investors who've done the structural work. They're not looking at the price chart asking if $30 is too high. They're asking what $30 looks like against a decade of industrial demand growth and constrained supply. They're asking whether 30 today becomes 60 or 80 in 3 years, if the green energy build-out hits, even half its projected pace. And they're accumulating quietly, methodically, without fanfare, because the last thing they want is for everyone to figure this out at the same time. This pattern, quiet institutional accumulation before a major price discovery event, is one of the most documented and recurring dynamics in commodity markets. It happened in oil before the 2000s supercycle. It happened in copper before China's industrial expansion rewrote the demand curve. It happened in silver itself before 2011. The public catches on after the move, the prepared catch on before. And this is where the story changes completely, because the macroeconomic backdrop for silver heading into 2027 may be the most supportive it has been in a generation. Not just because of green energy, not just because of industrial demand, but because of what's happening in the global monetary system at exactly the same time. The world's relationship with the US dollar is shifting. Not dramatically, not overnight, but measurably and unmistakably. Countries that used to hold dollar reserves without question are diversifying. Central banks globally have been buying gold at rates not seen since the 1960s. And when central banks reach for hard assets, real, tangible, finite assets, the message they're sending about their confidence in fiat currency is louder than anything they say publicly. Silver historically has followed gold's directional moves, but with more volatility on both sides. When gold runs, silver tends to run harder. When gold consolidates, silver can lag. But the gold to silver ratio, the number of ounces of silver it takes to buy 1 ounce of gold, has historically oscillated around levels that suggest silver is still deeply undervalued relative to its historical relationship with gold. When that ratio has been at historical extremes in the past, it has always eventually compressed. Always. The question was never if. The question was always when. Because what happens next matters more than people think. If gold continues its run toward new all-time highs, driven by central bank buying, dollar uncertainty, geopolitical tensions, and the slow unraveling of confidence in government debt sustainability, silver doesn't just participate, it historically amplifies. The same forces that push gold higher tend to push silver further, faster, because the silver market is smaller, far smaller. It takes significantly less capital to move silver meaningfully than it does to move gold. And that is a feature, not a flaw, when the capital starts flowing in. Now let's talk about something that rarely gets discussed in these conversations, and I think it should, the psychological moment we're living in. The American middle class has watched inflation hollow out their purchasing power over the past few years in a way that felt deeply personal. Groceries, rent, insurance, gas, the numbers that economists call manageable felt anything but manageable at the kitchen table. And somewhere in that experience, for millions of people across this country, a question started forming. A quiet, persistent question about whether holding dollars in a savings account was actually protecting anything. That question, once it takes root, tends to lead people toward hard assets. Gold is the famous one, but silver, priced low enough for everyday investors to participate in meaningful quantities, is accessible in a way that gold isn't. You can walk into a coin shop or buy online and own real, physical silver for what amounts to a few tanks of gas. That accessibility matters psychologically. It matters for adoption curves. And it matters for who drives the next leg of any sustained price move. And look, I want to be clear about something. Nothing in financial markets is certain. Silver is volatile. It can test your patience for long stretches. It has a history of frustrating the people who get emotionally attached to a timeline. The smart money that's accumulating right now isn't doing so because they know exactly when the price moves. They're doing it because they believe the structural case is strong enough that time is their ally, not their enemy. Position first. Be patient second. Let the fundamentals do the work. That distinction between speculating on short-term price moves and investing in a long-term structural thesis is the difference between getting shaken out and building real wealth. There's a line from the old commodity traders that I keep coming back to. They used to say, "The market can stay irrational longer than you can stay solvent if you're fighting it with leverage and emotion. But if you own the physical thing, the actual metal, sitting somewhere safe, not leveraged, not borrowed against, time works in your favor. Every month that passes with demand running above supply is a month the foundation gets a little tighter." That's what silent accumulation looks like from the outside. Unremarkable, patient, purposeful. So here's where we land. Heading into 2027, the confluence of forces around silver is unlike anything we've seen in a very long time. Industrial demand driven by technologies that aren't going away, supply constraints built into the geology and investment history of the mining sector, a macroeconomic backdrop of dollar uncertainty and central bank hard asset buying, a gold to silver ratio at levels that historically precede compression, and institutional money that is clearly, or not quietly, methodically, building positions before the broader public connects the dots. You don't have to be an institutional investor to understand this story. You just have to be paying attention before the crowd starts paying attention. And that's what this channel is about. That's why we're here. The Bullion Horizon exists to help people see around the corner, not to tell you what to do with your money, but to lay out the picture with enough clarity and depth that you can make an informed decision for yourself. Before you go, I want to hear from you. Drop a comment below. Where do you think silver is headed before the end of 2027? Are you already holding? Are you watching from the sidelines? Are you skeptical? I genuinely want to know, because this community is one of the most thoughtful conversations happening in the financial space, and your perspective matters. And if this video made you think differently about silver, even a little bit, please share it. Not as a favor to me, but as a favor to someone in your life who should be having this conversation. A family member, a friend who's been asking about protecting their savings, someone who deserves to see the picture before the window closes. Because that's the thing about financial turning points. They don't announce themselves. They don't run advertisements. They don't send a warning before the crowd figures it out and rushes in. They simply pass. And you either understood them early, or you understood them later, looking back, wondering what you were thinking. The smart money already made its decision. The only question now is whether you make yours.